Welcome to Ask Fear and Greed, where we take your questions and do our best to answer them. I'm Michael Thompson, and good afternoon, Sean Aylmer.
Good afternoon, Michael.
Sean, today's question is a good one. They're all good questions, actually. I shouldn't single this one out as being any better than any others, but it is a good one. It has come from Brian, and he has shared it with us via the website. You can obviously go to the website, fearandgreed.com.au, or LinkedIn or Facebook or Instagram or anywhere. You send it by carrier pigeon. I don't really mind, just as long as it gets to us. Brian says, Sean, and Michael. I'm going to insert the end Michael, even though Brian didn't say it.
No, I've seen the question. Sean, yep, go on.
Sean and Michael, does the rise in ETF, exchange-traded fund-based investments, contribute to greater market sensitivity? If we were to imagine a market entirely owned by ETFs, there would be no direct price setting by individual investors. Is there a risk of moving towards such a scenario?
So I don't think there is a risk. I think people always want to take a punt. Be it an institutional investor or a retail investor, they think Commonwealth Bank will do right. You can't have an ETF on Commonwealth Bank. You can have an ETF on all the banks. So I think we won't have a situation where that occurs. The question about ETF-based investments contribute to greater market sensitivity, probably not, I wouldn't think. I mean, I can't foresee the circumstances where that may happen. There might be more volatility. When I think about this, I think of some of the risks about ETFs. So we often talk about ETFs, and there's certainly huge growth in ETFs, plenty of good stuff about ETFs. But there are also risks. And so I thought maybe to answer this question, we should go through some of those risks. And I've really got Vanguard to help on this one. So the single biggest risk in ETFs is market risks. You can have the best ETF in the world, and if your market falls by 50%, well, the value of your ETF is going to fall by 50%. So it doesn't matter how cheap it is, how efficient it is, how transparent. If the market falls, your ETF falls. That's the biggest risk. There's also the judge your book by its cover risk. There are thousands of ETFs out there. Like in the US, there's more than 3,000. There are so many choices. So you might buy a biotech ETF. But the difference between the best performing biotech ETF and the worst performing biotech ETF on Wall Street is often vast. That's because what the definition is by the people creating the ETF can be totally different. So you have to look under the hood, open the front cover and start reading the book to really...
I'm loving the mixed metaphors here. So where it's under the hood of the book that we've judged by the cover of the badge on the car.
That's it. That's it.
This is good. But really, it's just research, right? It is just actually kind of understanding what is within that ETF. That it is not just going by the name. You actually have to just be aware for yourself. Bit of legwork.
Yeah, and I've been guilty of buying an ETF because I like the name rather than looking underneath the cover of the book. There you go.
Okay. All right.
Okay, there's exotic exposure risk. And these are Vanguard suggestions, remember. Exotic exposure risk. ETFs have done an amazing job opening up different areas of the market, right? So we used to buy stocks. Now you can do all sorts of things, commodities, currencies, options, different strategies, all types of things. But is having access to these sometimes complex strategies necessarily a good idea? Again, it comes down to doing your homework. If you are moving beyond vanilla stocks and bond ETFs, they get pretty complicated, a bit hard to understand sometimes. That's another risk. There's a tax risk. Now, this is, you need to know the ins and outs of the tax rules on different asset classes. So, for example, if you buy an ETF in the US based on gold, that will have different tax implications to buying a Wall Street equity ETF. Currencies are treated differently again. It gets very complicated. Another risk there. There's also a shutdown risk. Plenty of ETFs out there, plenty of popular, but there are a lot that are unloved. In fact, over the last 5 years, on average, 110 ETFs closed per year. There's an issue there. I mean, you should get your money back. However, you may not, there could be tax issues with that. It may actually be quite the process to get your money back. So that's another risk. There's also trading risk with ETFs. You can't always buy an ETF with zero transaction costs Like any stock, an ETF has a spread that can vary, particularly for trading exotic things that might be quite costly. There's the hot new thing risk.
Yes.
Where something comes to market and it sounds fantastic and you think I must get some of that. But if you actually did your homework, read the marketing materials, you might realize that maybe the strategy is not real good or the hot new thing ain't so hot. So there's that type of thing. There's also the crowded trade risk, which is kind of like the hot new, hot new thing risk. If everyone jumps into it, maybe it's no longer cheap enough. So there's a risk there as well. So there are lots of risks with ETFs that you have to think about. And, if you're going to boil it all down, it's about doing your homework. I don't think they're ever going to be that much that the market is, sort of prices are set in the market by ETFs. I think that would be unlikely. But some of those risks that I mentioned could lead to greater market sensitivity, as to Brian's question, on how things are priced.
It's quite a list of risk, isn't it? But I mean, in many cases, as you say, that risk can be mitigated by a couple of the basic principles of investing in terms of making sure you're doing your homework, that you're getting advice from professionals who know what they're talking about. But also, when you mentioned, was it exotic exposure risk, the fact that ETFs have kind of opened up a new world for a lot of people and exposure to things that they may not have invested in, like various commodities or different kind of option strategies and things. Goes back to what Warren Buffett said, wasn't it?
Oh, nice work, Michael. Yes.
What did he say? Never invest in a business that you can't understand or that you don't understand or something like that. It just, the principle's still the same. Sure, you might have access to it now because the ETF has made it available to you, but if you don't understand it, then it's on you to make sure you do understand it. Yeah.
And with those ETFs, right, if the ETF provider can't explain it to you, don't go near it.
Yeah. Anyway, look, it feels as though we have not just covered Brian's immediate question. We've probably covered about 8 other questions that Brian didn't ask. And it also feels like I've injected myself enough into this that I earned being involved in it. Where he didn't address me. He didn't address it to me at all. But you know what? Doesn't matter.
No, well done. Well done.
Thanks, Brian, for the question. And thank you, Sean, for answering it.
Thank you, Michael. Thank you, Brian.
Remember, if you have got something that you would like to know, then please send it on through via the website, fearandgreed.com.au. Send it through LinkedIn, Instagram, Facebook, and just remember, it's both Sean and Michael. There's 2 of us here. It's not just Sean. I'm Michael Thompson, and this is Ask Fear and Greed.